Welcome to another episode of the TOA On AIR podcast. Today I'm joined by Sheel Mohnot, and Sheel is the co-founder of Better Tomorrow with, quite the Twitter presence and following, a seed stage venture capital fund investing in Fintech globally with an average check size, I read, of 500,000 to 3 million. Welcome to the show, Sheel.
Thanks for having me. Glad to be here.
So, Sheel, I was digging a little bit into your profile, and there's one thing we have in common, maybe more, but one kind of random thing, which is you sold the company to Groupon. I sold my first startup. My first startup was also a couponing startup, and we almost sold to Groupon, but we ended up selling to Germany's biggest player, which was Daily Deal, which later sold to Google. Yeah. Where I learned one of my hardest founder lessons, taking all cash rather than any equity, which was offered. Because I thought couponing is over. And then, 6 months later, it was sold to Google. But yeah, maybe let's start there. What do you think happened with Groupon and couponing? Because in a way, it was sort of an attractive proposal. I feel, the issue may have been that, there was just not a lot of return and loyalty among the people that would shop for these coupons. But the company still seems to be around, which is also incredible after all those years, but not obviously owning a lot of mindshare anymore among culture.
No, not at all. Yeah, so for those maybe younger listeners who may not be familiar, because this is an old story now. It's over a decade old. Groupon was, for a short time, call it 2010 to 2012, the hottest company around. They went from basically zero to getting an offer at a $6 billion valuation by Google, to then going public and reaching a $20 billion valuation. And the company is a couponing startup. So it lets you, it started out as you get one email a day in every city. And it was the offer to buy a discount at a restaurant, like 50% off. And the way their business worked originally was they actually took 50% of that and they marketed it to the restaurant as saying, this is great marketing for you. You're gonna get in this email. There'll be, thousands and then ultimately millions of people. So think of it as a marketing expense. Now, what ended up happening was many of the folks who ended up doing these coupons never came back. They were just staying on the coupon treadmill, going over to the next coupon. So it got a lot of hype, and for a time, was doing tremendously well. And then I think people just got fatigued with it, primarily on the restaurant side. And they originally were getting many of the top restaurants. And then ultimately it just got worse and worse and worse to where they only had the worst restaurants and other things around. So it didn't really work. Now, our business is a payments business, and they acquired it to build merchant products. It was a totally new angle for them. When they acquired our company, that day, the stock went up by $600 million in market cap. So the market really loved what we were doing as an add-on to Groupon, but we were never able to integrate it that well. And ultimately, Groupon spun it out as a separate company and sold it.
And now I just saw the market cap of Groupon is 140 million.
Yeah,
but it's but it's still around, and certainly it was exciting. I mean, you would have these copycats, pop up all across the world, and it was this race to the bottom, really.
totally.
Very sales intensive. Learned lots, in that time for sure. Well, let's fast forward, but maybe, you know, the decline in stock price is maybe a good lead into sort of the first part of this conversation, where I want to talk a little bit macro with you. So what is your, you know, current feeling on, you know, the sort of global macro technology ecosystem, you know, when it comes from to sort of public markets? Let's maybe start there, but then also sort of drilling that down, you know, downstream to what you see in the earlier stages of technology companies.
Yeah, we are hurting. Is the overall. So I'm a fintech investor, as you mentioned, and fintech is down much more than the overall. But I think overall, you know, we peaked in 2021, towards the end of 2021, and we're down sort of, the NASDAQ is down very significantly since then. The NASDAQ is the index that mostly has the tech companies. And fintech, I believe the fintech public companies were down 80% last year. So just an insane decrease. And that has had major trickle-down effects. So if you think about, if you're a late-stage investor, your companies went public, you, in many cases, were not able to get out. And in that case, some of your holdings, some of these companies are worth less than they were at the Series A after going public at a multi-billion-dollar valuation, and then just things have fallen down very rapidly. We talked about Groupon. That was a more than 10-year story, but there are companies that are only 2 years old that have had a similar trajectory, and 2 years old in the public markets, and that's totally wild. So it's meant that the growth at all costs mindset that comes with a zero interest rate environment that we had in 2020 and 2021 is over, and now we shift from growth to profitability. And some companies just are not able to make that shift quickly enough, and we've seen what happens because of that.
So yeah, I guess with Groupon, it was mostly kind of based on the decline was, you know, due to sort of the lack of sustainable business model. Here we're looking at sort of, you know, macro impact of, you know, of course, you know, rises in interest rates. Or do you think also fintech as a segment and the companies that we've seen were maybe not getting the traction among customers that you guys were hoping for?
Yeah, I would say it's okay. So the low interest rates. So there's different kinds of businesses. There's like consumer businesses, and then in our portfolio we have a few of those, but we have more enterprise businesses that sell into, a lot of them sell into other fintech companies. And so let's talk about consumer businesses first. Consumer businesses, you know, a lot of them were spending money unsustainably to acquire customers. And in a zero interest rate environment, your CAC to LTV can be worse, because if interest rates are low, $1 in the future is worth the same as $1 today. So you're like, okay, it doesn't really matter. Like, I'm okay spending, you know, multiple years upfront to acquire a customer, because I'll make that money over time. And then as interest rates rise, all of a sudden you're not as okay with this bad CAC to LTV. And then all of a sudden you have to figure out your business. And if a CAC to LTV, you're willing to pay 2.5 years to acquire a customer, and today you're only willing to pay 1 year or less, 6 months, then it may be that your business is not worth anything. Because if that's what people are willing to pay to acquire a customer, then it could be that it's just impossible to acquire a customer at that price. And the incumbents who already have the distribution and brand name are going to win. And that's really unfortunate. And then there are trickle-down effects from that, which are, if this consumer fintech company can't acquire customers profitably, then they're not going to be able to raise money. And as they don't have new customers, that enterprise company that was selling to that consumer company that was relying on their customer growth is now also screwed. So we've seen this trickle-down effect pretty rapidly occur over the last year and a half. And I would say in our portfolio, like 75% of the companies are not hitting the numbers that we expected them to hit. And in converse, I would say 2 years ago, 75% of our companies were exceeding their numbers. And so it makes you feel like, as a venture capitalist, you feel like, oh man, I crushed it. Like all my companies are doing super well. This is amazing. They're raising more money. You kind of feel like a genius in 2021. And then in 2022 and then 2023, you realize, oh no, I was just a function of the market performing as the market did. And so that's been interesting. It's certainly a little less fun than it was in 2021, but also much more real. And I'm excited. Hopefully, there'll be fewer investors, fewer companies going forward, which I think is what we need.
And how do you react to that? Like as a VC, we saw also over the last 10 years, specifically over the last maybe 5-6 years, sort of deployment cycles becoming faster and faster. VCs raising funds faster and faster. How do you see that now for you as a fund manager? Are you laying low? Are you waiting it out? Are you hoping for the macro to change, or are you rather looking at maybe financing, very new business models that, may have better metrics and maybe not, do the growth financing that I think you also have a certain, sort of a check size committed to, in your overall fund in doing?
Yeah.
Like, what's your strategy at the moment?
Yeah, our strategy hasn't changed that much. Ultimately, we always want to invest in companies that will ultimately deliver a lot of profitability to their to investors, and that hasn't changed. I think we fortunately didn't have too many companies that were this like growth at all cost mindset. What did happen was some people changed as the market told them to change. They started doing things that didn't make as much sense, and there's no one to blame for that. I think it's just the market overall. In terms of our own investments, yes, we do have a growth fund. So we have a $150 million seed fund and a $75 million opportunity fund. We are still investing from the growth fund, but what we look for in an investment is, as you said, a little bit different in that we are looking for more companies that can be profitable today, not in the distant future. And then valuations at growth have come down very, very substantially.
And I saw also, you tweeted something that I think is an interesting topic. Sort of you tweeted just, I think today or a few days ago, corporate VC funds shift strategy often. Common to go from returns focused to strategic. Is that, also how, you see sort of the exit scenarios for your portfolio companies, that, there may be, more potential wins in the books by selling to corporates from a strategic perspective? And do you see now companies also shifting their strategy?
Yeah, we have seen the companies that went IPO, most of the fintech companies that went IPO in 2020, 2021 are trading down very significantly. And in many cases, it would have been better to take an acquisition. I think for the past many years, it was seen as a success story to IPO your company. But really, financially, the companies that sold did better. Now,
Mhm.
there's a question today about what kind of acquisitions would happen. As most of the potential
Mhm.
acquirers' stock prices are depressed, they don't want to
Yeah.
acquire with stock. And some of them are doing stock buybacks, but then they also don't have that much cash. So I think there
Mhm.
are just going to be fewer exits, many fewer exits this year and the next as compared to the previous couple of years. But, I think we have seen some recently. I think we'll continue to see a trickle of exits in the fintech space, but certainly not what we saw before.
And would you say, I mean, is there a number that you're looking at, maybe not for your own portfolio, but generally in the market? Is there sort of, Silicon Valley kind of worst case scenario that people talk about, like in terms of, how many more companies will we see fail over the next 3-4 years, not getting, the growth financing, that is necessary? I feel like in the seed stage, things are still, in the very early seed stage, things are still moving.
Yep.
But specifically when it comes to growth, like are we looking at a 100% increase in failure rate, or?
Yeah. Yeah. A lot more companies will fail. So to give you an idea, when we started our fund, we modeled that of the seed companies we back, um, some percentage of them will fail to reach follow on. 25, 30, 40% will fail to raise a follow on round. Instead, what happened was in 2021, every company in our portfolio that wanted to raise capital was able to raise a follow on round. And this is actually not great,
Mhm.
because for a variety of reasons, but like one, people are building things that they shouldn't be spending time on. They'd be better suited going to work for somebody else. There's too much competition for the same ideas.
Mhm.
And then for us as a VC fund, we end up spending a lot of time with founders with ideas that we know probably aren't going to work. Um, so this was actually probably bad,
Mhm.
that there was an overfunding in the market. I think that's changing now, which is for the better. The other thing we saw is, I mentioned a little bit, like a bunch of companies in the same category getting funded, and you would start a company, and then you would see 4 or 5 other companies doing the same exact thing, and
Mhm.
that makes any one company less likely to succeed. So I'm excited for that to change.
Mhm. And just, to bring it back one more time to the corporate VCs, because I think, in our audience, we do have quite a lot of people, from large organizations, innovation management teams,
Yeah, yeah.
corporate venture development studios, corporate VCs, of course. I mean, do you think that is the right strategy to go from returns focused to strategic? And it still rings to my ear. I once interviewed Fred Wilson, and he keeps on, talking about, how he's, generally quite pessimistic about corporate venture capital. What would be, your take, or what do you see in Silicon Valley? Or if you were a corporate VC, like how would you play it?
Yeah, it's one of these things where, like, if you're a if you're a Microsoft, um, do you really care about returns from this fund? Or, Microsoft's a $2.5 trillion company. So like whatever the returns are from this fund, you know, could be hundreds of millions. But it's way down in the future. Do they really care about that? Not really. What matters to them is something that could incrementally improve their business. If you could improve the Azure business by 1%, that would be way more worthwhile than anything you could do from a VC that's returns focused. So I think the whole notion of a returns focused VC doesn't really make that much sense unless, you think about it as being part of the corporate treasury. I could see that, but it creates other conflicts, which I worry about. So I really don't think it makes much sense to have a returns focused VC. If you want to do corporate VC that's strategic, I think that's fine. Typically not leading rounds, investing at B and beyond, typically, I think that's all fine.
And it may, yeah, and I mean, we have also seen in Germany, some examples where maybe the return mindset or the quick return mindset, ultimately led to, much lower returns. The famous example being Daimler, Mercedes investing in Tesla, having a 10% stake in Tesla, I think for 50, for 50 million, and then cashing it in, at a 10 or 20x return. Whereas I think it would be dozens of billions of dollars now. The stake had they kept the stake. And what's your you're gonna stick to fintech, right? And you see any new technologies? I mean, AI is probably the obvious, that will also sort of reignite the fintech developer community. And I may be wrong, but because obviously I don't know that much about the specific vertical fintech, but just from my vantage point, I just see less fintech companies sort of popping up and being introduced to us at TOA and so forth, because I think you're not that bullish on Web3, correct?
Yeah, that's right.
And so talk about that, what are some new technologies, and maybe also what's your beef with with crypto?
Yeah. Good question. Okay, so first, let's talk about fintech first. So fintech, I remain as excited as I ever have been about fintech. I think if you look at it from one perspective, financial services are 20% of global GDP. Huge numbers. And finance is inherently digital. It's numbers. And the merger of finance and technology a lot of it is yet to come. So we believe the future is quite bright, just looking from a macro perspective. From a micro perspective, of course, there are challenges in individual business models. There are challenges from a regulatory perspective, et cetera. But overall, do we believe that finance is still harder than it should be? Absolutely. Do we think that the software that we use to manage our lives should also manage our financial lives? Yes. So I think the merger of finance and technology is yet to happen fully. Now, we invest in fintech, but I mentioned this merger of finance and technology. So there actually are a lot of SaaS companies that now make more money from finance, fintech. So an example would be Shopify, an example would be Toast here. There's many other vertical SaaS businesses that are now getting 30, 40, 50, 60% of their revenue from finance, either payments or lending, banking, payroll, all these other things. And so we are investing behind that thesis as well. So we have invested in some vertical SaaS companies. So you might look at the company and say, this isn't a fintech company, but to us, which maybe we're a fintech hammer, everything looks like a fintech nail. It is a fintech company. So can
you give us one example?
Sure. One of our portfolio companies is called Lunar. It's a software company for hospitals. And you might say, this is a vertical SaaS, this is a healthcare company. But for us, they actually have a huge fintech component. They deal with insurance, they deal with billing, they deal with a bunch of other aspects of finance. So for us, this is a fintech company, as well as being a vertical SaaS, as well as being a healthcare company.
Yep.
And it's interesting, their Series A was led by a generalist fund, but the healthcare investor within the generalist fund.
Mm-hmm. And before we get to crypto, because maybe I'll have a few follow-on questions there, but I mean, how do you see the sort of the emerging credit card or personal credit let's say bubble? I guess one can probably talk about one that we've seen now sort of appear post-COVID. Like, is that worrying to you also as a fintech investor?
Yeah, I think, look, COVID and the knock-on effects of COVID took us to a zero interest rate environment that is quite appealing for credit. And if you are getting money cheaply, and that means you can lend money cheaply or more cheaply, and you have a spread, if all of a sudden your costs have gone up very substantially, then the business model, frankly, just may not make sense. And we didn't invest in too many companies in the credit space, fortunately. And so I think we feel okay about it. But I think a lot of these companies just will not survive at all.
Speaking of survival, then let's talk about the crypto. So I mean, it's interesting because I mean I am quite bullish on Web3 personally.
Yeah.
I wouldn't say I have deep domain expertise, but it's certainly one of the areas in tech that I'm personally just most excited about. Being still fully aware that obviously it may never come to fruition, that vision, but I can certainly rally behind that vision, of sort of self-custody, of composability, of just this self-governance of our data, and the potential business models attached to also us controlling our data and deciding whom to sell it to and whom to trade it with. How can that not excite a fintech investor?
Yeah. So look, I think all these things you mentioned, self-custody, et cetera, they do solve some problem, but then they create many, many other problems. And I've yet to find many use cases that I find really solve a problem that people face. And if you look at the companies that have done well, they primarily have done well investing into crypto as a speculative asset. And so companies like Coinbase that allow you to invest in crypto, or companies like Chainalysis that analyze for law enforcement and others, have done quite well. But beyond that, I struggled to find many use cases that I actually get excited about. Now, it's not to say that we haven't invested in any. We have invested in one company. It's called Kaliza, and it's an API that gives so international customers access to digital dollar accounts to save, transact, and invest. So if you run a company in Brazil and you're exporting to the US, you may want to keep your dollars in USD, and you can keep it in USDC via Kaliza. That's one thing that I thought made sense. A lot of the other stuff I've never found a great use case. Now, all that being said, despite all of that and my negativity, perhaps, probably 10 to 15% of my net worth is in crypto.
Okay. Interesting. May also just mean you got in early and you're like, let's just keep it running. Or maybe it's a mixture of both.
Yeah, it's a little bit of that.
Yeah. Yeah,
It's a
please.
little bit of getting in early, but not as early. Like actually, my first tweet on the topic, I think Bitcoin was 11 cents, and I responded to somebody saying, "This is never going to work. Like governments aren't going to allow this to take place." And of course, at least for the interim 13 years or whatever since that tweet, I've been wrong. Although it does feel like the US certainly is cracking down on crypto and doesn't want it to exist.
Yeah. I mean, one interesting conversation, and I thought an interesting description also of the potential of crypto that I had was with the founder of 1KX, which is a crypto fund, Lasse Clausen. He's been an old timer at TOA. I would introduce you to him, but I think he's just moving into a new place in the US at that time. But he described it as sort of I think 30% is the number that he mentioned of the global economy is dedicated to ensuring trust between economic participants, right, and managing and securing that trust, and whether that is banks or law firms and notaries, etc. And that is basically the market segment that crypto is going after, right? That we don't need third parties to manage and secure that trust, in that economic relationship between two or more participants, if we bring these economic activities on chain. And I thought that was a really interesting take.
Yeah, I think, look, if you think about what finance is, it's infrastructure that allows you to exchange resources with unknown people and businesses. And if you don't need an intermediary, you don't have to trust an intermediary, that all makes sense. I just don't necessarily think it's possible. And we're 15 years post the Satoshi white paper. We are 13 years after I first heard about it. And I've just never seen something that I thought I really got excited about that was solving a problem. And like, if you look at it from an academic perspective, it's very interesting. From a practical perspective, I still struggle to see use cases. What's most telling is we are fintech investors. We have 50 plus portfolio companies. And if there was a solution that was better, faster, cheaper, trustless, we would use them. We would love to use them. But we haven't. And I know you had mentioned AI, and sort of very quickly, AI has gotten so easy to use that like most of our companies use AI in some aspect of their business.
Yeah, that's been incredible to see. Definitely agree on that.
Just so quick.
Well, let's see. We'll check in on it maybe again in 5 years.
Yeah, we should absolutely. Yeah.
All right, let's shift gears towards the last kind of section of the interview that I want to talk about with you, which is sort of going to the micro level, of founding a company, entrepreneurship in general. What you've learned in founding your own company, but also in advising your portfolio companies. You are set to take a very hands-on approach also with the companies in your portfolio, saying that in the seed stage, you can actually move the needle here, and that advice is maybe needed or asked for also among the portfolio founders. Tell us like what are some of like the mistakes that you feel are hard to sort of understand, learn, or avoid as a early stage founder that you as a VC can really help with? Like, what are some of the recurring things that you see?
I think there's a lot of like general stuff that people are reinventing the wheel again and again that you don't need to do, that a VC can help. Like, hey, I've seen people go down this path. you don't want to go down this path. Like, for example, it could be when setting up, deciding to partner with a bank rather than directly rather than an intermediary, or certain vendors that we've seen people partner with that have never delivered on time once. We can help
And
avoid those
so
sort of
basically, if I
pitfalls.
get that right, like don't partner with a bank directly.
Not necessarily,
Yeah,
but if you do it, be mindful that you're going to miss deadlines. It's going to be more painful than you think, all that sort of
yeah,
stuff.
yeah. And what about brand? Like, what role does brand play in fintech? And is brand something that, I feel like, with, SaaS, like it was so functional, the way that products were positioned and marketed. And, the focus was so much on, product development and, good product sell, maybe, some performance marketing. But, brand and kind of brand building often, I think in America, maybe even less so, but in Europe, was often overlooked in sort of, the early stage startup game. Like, how do you see the role of brand?
Yeah. You mentioned something earlier, which was trust. Trust is a very important thing if you're giving somebody money. You have to trust them. And you don't trust a company you've never heard of typically. So you need things that build that trust. And brand is a big part of it. You need to do an early stage, you do anything you can to build that trust. And we think building brand is part of it. That being said, I do advise companies that are consumer focused not to focus on brand marketing that much. I think in the early days, when you talked about quantitative marketing is much more bang for your buck than brand marketing. So it's not brand marketing specifically that you need to do, but you need to worry about building a brand that resonates with consumers and creates trust. And
in Silicon Valley, yeah, sorry.
Some of that, I mean, you mentioned product, some of that is the product. So like, there are a lot of crossovers between the brand and the product. There's, it's an integrated, of course, approach.
And have you seen a difference now in sort of the founder culture and sort of the pitching culture and the relationship that founders have to VCs, coming out of a few years and sort of, very public, scandals and, even, crimes that we've seen in the technology space, and articles being written and so forth. And if I can give you the perspective, as a European or maybe a German, specifically, and I don't want to overgeneralize and stereotype, but there certainly, always was that, feeling in the early days of, the German technology and startup ecosystem of like, you gotta go to the US, you gotta learn how, if money is raised there, how companies pitch, you gotta be more aggressive, you gotta sell a bigger dream. You shouldn't be so humble, you need to have bigger numbers. Like those were really the advice, that we've heard. Do you see, things changing, or is it just, a few sort of rotten apples that, exist in any industry and that maybe were elevated a little bit because of, the media exposure that some of them had sought also prior to the demise?
Yeah, I think, look, the difference between Europe and here is here over the past 50 plus years, we have a history of venture financing companies, and there has been a lot of success in companies that were venture funded. If you look at the top companies in the world today, by market cap, Apple, Microsoft, Google, Amazon, Nvidia, Facebook, Tesla, all of those were venture capital funded in Silicon Valley. Microsoft is in Seattle, but also and Amazon too, but both also raise money from Silicon Valley. So these are, 10+ trillion of market cap that when they started, pretty much had no revenue. And so there's a history of funding crazy ideas and expecting super, super outlier returns. That has not been the case in Europe as much. The top companies of Europe were not venture funded. And so it's a bit of a disconnect there. But that's changing rapidly. People are seeing the successes of many of the companies in Europe, and I think it's rapidly changing. But I think Silicon Valley, even compared to other places within the US, is more likely to fund a crazy idea than like New York or Texas or something. And I think New York is probably more likely to fund a crazy idea than London or Berlin. And then China is a whole nother beast, which is funding all sorts of crazy ideas. But that's my overall take. I think it's still easier to get people to believe here. Now, we may be wrong, and it may be that there's just too much money in the ecosystem altogether, and the returns for the entire industry are going to be bad. Entirely possible that that's true. And I kind of believe that. I think there's too much money in venture capital. And it's a bit of a prisoner's dilemma thing where we can all raise bigger funds. Like, that's the limiting factor on our fund size is not how much we can raise. So until people start reducing the size of their funds, the industry returns as a whole are going to be lower because people are just overfunding and valuations are going up.
And do you feel that, maybe then also the power law, is that written in stone, or do you feel that maybe funds will have a more balanced kind of maybe lower return, but you'll see, less, super home run exits, but maybe VCs are becoming more diligent and, maybe less risk taking, and hence, and more strategic exits, less IPOs, so that you will have, more, mid-range returns and less sort of, super home run returns?
I think it's possible, but that means that the industry will have lower returns overall, probably, if you don't have this home runs, even if you have a bunch of mid-range. The thing that you realize, I'd read about the power law, I knew about it, but I didn't, until I experienced it myself, I didn't really get it. Where like from my first fund, I have a few companies that are each worth multiples of the fund, and everything else could go to zero. It doesn't really matter.
So one question, that I ask every, person on the pod, which I'm kind of obsessed about, is the question of pivots. And specifically, as it sort of confronts a founder who may not yet have perfect, product market fit, and who may struggle with the question of, should I keep on iterating, or should I really give up, what I'm pursuing at the moment, take my team, take maybe the industry, the vertical that I'm working in, but, really try something totally new, and go after a new product. And we've seen, success stories in both, right? We've seen the Twitter success story,
Totally.
With the total pivot, but then we also hear the success stories of founders who will say, you gotta keep on iterating, you gotta keep on working, when you have that vision and that mission, it may take a long time, but, ultimately you'll find product market fit. I'm sure you've had, questions like this, pop up. Like, it's probably not an easy yes or no question, but like, I wonder, like, what are some of the questions a founder can ask themselves to then better, come to an answer? Like, are there, any models, any mental frameworks, how do you, evaluate that question as a founder, which I really think is one of the most difficult questions a founder faces?
Yeah. One thing I'll say is, from my first fund, of our top 5 portfolio companies, 3 were pivots of some sort since we invested. And like one of them, actually 2 of them pivoted from, or one of them pivoted from serving enterprises to serving consumers, and one of them pivoted the other way, actually. And I think it's an important decision. I think the thing that's hard for an outsider to know are if the team internally just like isn't motivated on the idea. There's sometimes that like the team emotionally just loses interest in an idea, and you may need to pivot or you'll lose people. I think there are times when you figure out the business is never going to make money. Like this, the business that we're going after today, I had a conversation about this with the founder recently. Like we basically have 6 months to decide. The company has a few years of runway, but we decided in the next 6 months, we want to understand if this business is ever going to be a hugely profitable business. And so we have live customers today, but we still need to do more customer development to figure out, is this the business we want to be in? Or can we make a mini pivot and like add on to the product? I think, so some reasons that you pivot are the business isn't going to make money. The market just doesn't develop in the way you think it would. So we invested in a company that was building a product for fintechs in Southeast Asia, and the market, they are selling into other fintech companies, and there just aren't enough companies for this to be to get like hundreds of millions of dollars of revenue, because like even if they saturated the market, it just wouldn't happen. And I think we thought the market was in a particular acceleration rate, and we thought it would stay at that rate. Instead, it kind of like flattened out. And so now the market probably will develop, but it's going to take a few more years, and the company doesn't have that much money. So now they're pivoting into something else based on what they were doing. And then, the other thing that can happen is competitive set. So I think, the things we mentioned were like team has basically given up and wants to try something different. Competition, market response, or financial viability. And I think all of those are good reasons to consider pivoting. In terms of when you specifically decide to do it, it really is a discussion you should have with the team and your investors, and just figure out if you want to give it another shot or not.
2 last questions, Sheel, as we wrap up here. So we already hinted at that, and specifically before we started recording, we talked about it a little bit, sort of this fragmentation of the technology industry. I would love to hear your thoughts on this. Like my feeling is that, maybe 10 years ago, there was like the startup industry and the startup world, and it was, a culture, and it spread across the world. And, we had Hacker News and Y Combinator, and, everybody was, looking at the F8 and, other conferences, globally. Now it seems that, the areas become, very specialized, so the example that I love to give is the climate industry, where, somebody who works in climate tech, even in the climate tech, let's say startup world, You have a carbon removal company, you have energy, storage, you have, circular economy companies, and they don't really share anything. It's not like when we had the App Store come out and everybody was selling, products to one another and marketing on each other's, platforms and so forth. It seems to become just very specialized. Do you still sort of see that? Like what's your take on this? Like, is there still this, sort of startup culture? Also companies, large enterprises, over 10 years, they were adapting this. They were, building their startup and venture studios. They wanted to become like startups. They, would communicate that publicly. Is that flattening out? Is sort of the startup, sort of ingrained now in the wider economy? And now we're just talking about different technologies and solutions?
Yeah, certainly. I mean, since I got into this business, not venture, but technology startups, it's changed so much to your point, just like everybody knows what it is now. We were like a niche community. Now everybody knows about all these companies. And that's kind of happened as these companies have gotten more successful and we've gotten in the media and all that. It just has become, technology has become pervasive. It's funny you mentioned specialization within climate. The same is true in fintech. So in fintech, we have funds that only do consumer fintech. We have funds that only do API fintechs. We have funds that only do insurance fintechs. And so sort of similar to what you have in climate, we have here. Actually, there's a fund that's only dedicated to identity-related fintech companies, which I thought was not enough of a category, but apparently is. So I think there is a lot of specialization. I think there's a spectrum, and we go, what's in favor, out of favor is specialized versus non-specialized. When we were starting our fund, it's actually Mark Andreessen's one of our LPs, and he told us, he said, what you want to do is be specialized enough to build a brand in what you're doing, but be general enough to be able to invest in whatever you want to. And so we've kind of done that. So,
that is
we are known for
yeah.
fintech. We're known for fintech, but we actually have a sign in our office that says everything is fintech. So,
Yeah. So you're not looking to, are you open to raising very specialized funds in, certain fintech areas?
I don't think so. I don't see what the benefit would be to raise a more specific fund. I think fintech is general enough. We have had people interested in giving us money for a more specific thing, but it didn't make sense to us.
And then lastly, and sort of related is, like, what's your information diet then? I mean, how important is it for you, professionally speaking, to also read about other verticals that are not fintech, other technologies, maybe even things outside tech, versus, just becoming more and more deeply ingrained and knowledgeable about, your own space and vertical?
Yeah.
How do you manage that?
So I'm a very active user of Twitter that you mentioned, and I consume a lot from Twitter. I read Hacker News. I would say like Twitter gives me a lot of what I need because I follow people and things that I'm interested in. And there's like random stuff. I mostly am interested in technology, but then I'm also interested in like urban planning and like other random stuff that I have nothing to do with my professional life, but I'm curious about. I'd say I'm like generally a curious person. I also like Tyler Cowen's blog, Marginal Revolution. So I read a lot about economics and then technology, but mostly I mostly stay within my lane of technology.
Sheel, thank you so much for your time. We're really looking forward to seeing you very soon in Berlin, and getting to know you personally. Where can we find you on Twitter now that we talked so much about it?
Yeah, it's at Pitdesi, Pitdesi, which has been my screen name since 1995 on AOL, America Online.
Nice. Sheel, thank you so much, and see you very soon. Yeah.
Yeah, absolutely. Take care.